Hey everyone, as you know, myself, Brandon, and Tom are currently in the United States following the Berkshire Hathaway annual meeting. But in the meantime, I've got some scheduled content to kind of sprinkle in between the stuff that we're creating over in the United States. And today we've got a Young Investors podcast clip from episode 171. And in this, we discuss a couple of different questions that some of our audience had, including when to sell a stock, how do we kind of navigate that process. So I hope you guys enjoy today's clip and video. And if you want to stay up to date with content that we're posting from the United States, then make sure you're subscribed to all of our channels, and you can follow me over on Instagram if you want to see the day-to-day and behind the scenes of what we're doing. Links to everything down in the description below. But with that said, hope you guys enjoy this clip.
Hey, here's a big pressing question. I don't know, have I asked you this one already? This is a very big question, Hamish.
Yeah, you sure you want to do this?
How far will tech stocks fall?
All right, let me just get it up. Hang on.
To 3 decimal places.
That can't be right. Hang on.
This is saying 80%. Oh dear. Oh, okay, I'll ask you a proper one. Do you have any recommendations on material for learning more about when and why to sell stocks?
Oh,
That's interesting.
that's a good question.
How do you go about? Yeah, how what's kind of your general thinking when it comes to, or what's your logical thought process when it comes to when and why would you sell a stock?
Yeah, my thought process about selling is basically just the inverse of buying. So if a business, when I'm buying a stock, a business has to meet all of the key Buffett principles. So a business we understand, one with competitive advantages, great management team, and selling significantly below fair value or intrinsic value. So just the inverse of that is some of the reasons why I would consider selling a stock. So occasionally businesses will start in one industry and they might adopt a new industry. So a lot of businesses in tech at the moment are moving into cloud, for example. If you don't understand cloud and it becomes a big part of the business that is going to influence how that business will perform in the future, its future profits, then you need to be able to understand that new business. So in my view, if you don't understand that business, if you can't wrap your head around it, then that would be a business that no longer satisfies that first requirement. And then the same thing kind of just applies across the 4 key areas. So if the management team changes, you need to reassess the management team. Are they still effective at investing within the business? Do you have a track record that you can look at to see, yes, this manager is a good, can allocate capital effectively over time? And, the same thing applies for competitive advantages. So I guess in terms of material, I would probably say still the best material is to go through Berkshire Hathaway's annual letters, either just going through them one by one, or read something like the Essays of Warren Buffett, which gives you kind of a consolidated look at the principles that he talks about over many, many decades that he's written those letters. So that's where I think you'll find the best material on when and why to sell.
Yeah, I think what you say is 100% correct. I just think the 2 reasons you buy, it's exactly what you said. It's the inverse of buying. So you buy when you found a wonderful company and it's at a margin of safety price. And you sell a company when it's no longer a wonderful company, or when when you've bought in now it's hideously overpriced.
Yeah.
and you want to sell. And, everybody has a different opinion on when to sell, like in terms of overvaluation. You've bought in, you've made a good gain on paper, and now, do I get out? Some people, I think both of us kind of sit more in the camp nowadays of just go along for the ride a little bit more.
Yeah.
If you still see the future, obviously there's a point at which the stock price is so expensive that maybe even in 10 years from now, then the business still, if they keep growing, they won't have caught up to the current share price, in which case you can be like, oh, okay, that's I'm getting a pretty good offer right now, Mr. Market. I might take that offer. But yeah, you can, I think that's, sell. It's up to you when you want to sell, when you're looking at a profit. Some people take a modest profit, it doesn't matter. You still won, you still made money. Well done. You win investing. Or if more importantly, if a business changes in a way where it's no longer high quality, then that's a telltale sign that you need to get out.
Yeah, I definitely lean more towards Charlie Munger's wisdom on selling based on price, which is that if it's still a great business, hold on to it. And the idea behind that is whenever I'm investing in a company, my estimation of intrinsic value, what it's worth, is extremely conservative. That's part of our process. So if a business exceeds that, if a great business exceeds that extremely conservative idea of what it's worth, we shouldn't really be surprised, in my opinion. And you shouldn't just assume that it is worth only as much as that extremely conservative approach that you took to valuation. That if a business that's a great company exceeds your expectations, that that you should leave it in your portfolio and hold on to great companies. So yeah, that's kind of my thoughts on that.
You want to do this first one here?
Yes, let's do it. Hey guys, a year ago, I've bought a company and I think it's a pretty good business, but since then, I've learned a lot about valuing a company and now realize that I've overpaid for it. It came back down to my estimated level of intrinsic value, and I was thinking if it's better to sell it at a 30% loss and invest that money in something better, or just hold it and be patient since it's growing like I've estimated. What do you think about it?
This is a very interesting question. It's something that I haven't really thought about before. So you've from your estimations, you've overpaid by about 30%, and now it's come back down to what you actually do estimate your intrinsic value to be. I think you can take kind of two approaches. There is a case for selling if you can take advantage of some sort of tax loss harvesting. You can lock in a loss if that benefits you from a tax perspective, but you'd need to check I'm not sure what country you're from, so you'd need to check your country's laws around tax loss harvesting. But I think in Australia, for example, there just has to be or was that in the US? There has to be a 30-day period. Might have been in the US. There has to be a 30-day period before you buy back in. So you can harvest a loss, wait for 30 days and buy back in and they don't care. So you can do that. Or alternatively, if you have done more digging and you've realized, crap, I should have bought it where it is now, or maybe even cheaper than where it is now, but I overpaid 30% for it. You can still look, okay, is this business, is the growth trajectory, is it going to get there and surpass that price, based on the business fundamentals? Is it going to get there eventually? Maybe it might take a few years, but is it going to get there? And if you still think it's a great business, then I wouldn't, personally, again, not financial advice in any way, but I wouldn't be rushing to sell something just because I overpaid a little bit for it. If I bought, say, a really high quality business and I paid a little bit too much for it, I probably wouldn't freak out because I bought a really high quality business. So I'd probably say, I trust the management team, the numbers looking good, the internal reinvestment's doing really well. I'll just hold on. Sure, it might take a while for me to get back to where I was, but I definitely don't think this company is in danger of suffering in the long term and leading to a permanent loss of capital is probably the way to look at it. Yeah. What do you think?
Yeah, I probably have pretty similar thoughts on that. The only thing I would add is if in the question he said, should I invest that money in something better? If there if there is an opportunity that you can see that is a really great business, still high quality business, but is at a much better price, and you don't have cash around that you want to invest, because even if you have a business that's at fair value, if it's a really great company, it's probably likely to do better than cash. So you want to deploy the cash first. But if you don't have any cash, then maybe in that circumstance, you would kind of consider doing that. I kind of did this actually in my portfolio in 2018, where I invested in Thor Industries. And the first time I invested, I didn't invest a significant amount, but I was dipping my toes into it. And it fell, I think, about 30 or 40% relatively quickly. And it kind of made me realize or think, have I done something wrong? Did I do something wrong in my valuation? And it led me to do a lot more research into the company. And again, I reached a similar conclusion to you that it was a great business, but that my initial valuation was incorrect. It was too high. And in that case, I didn't actually have any alternative investments that I wanted to move that money into. So I continued to buy the stock as it fell to lower my cost basis. And I was very fortunate that that the stock fell significantly below intrinsic value. So I was eventually able to kind of save it. But who knows, what's going to happen with the stock in the future. So I think it all does come down to that last bit of your question. If there is a better investment opportunity where it's far below intrinsic value and it's still a great company, then it may make sense for you to make